Hello, and welcome to this presentation of Strax. My name is Hugo Lisjö, and I work as an equity research analyst here at Erik Penser Bank. Today, I have the big honor to introduce Gudmundur Palmason, the CEO of Strax. Welcome, Gudmundur. The word is yours.
Thank you, Hugo, and thanks, Penser, for having me here today to present Strax to you. The timing is good because we just released our Q3 report this morning, where there are a lot of changes in store within sort of the group, which is great to be able to explain here to you today. So in its simplest form, Strax develops consumer brands. We focus on two product categories: mobile accessories and personal audio products. And these then, mobile accessories are cases for your mobile phone or smartphone or your tablet, power products, and then personal audio products can be speakers or true wireless headsets. In terms of sort of the scope and size of the business, 120 million euros trailing 12 months, EBITDA of 6.3 million trailing 12 months as well. What makes Strax strong and sort of very suitable owner of brands in these categories is we have a distribution reach of more than 70,000 retail doors in North America, Europe, and Asia. So that's how brands that we've acquired in the past or launched internally benefit from being able to access quickly through our global sales organization these points of sales. We operate as a sub-segment of the smartphone global industry. Annually, there are roughly 1.3 billion to 1.5 billion devices sold. So you can argue that 1.3 billion consumers buying smartphone each year are sort of on the scope of potential customers of our products, no matter where they're bought or sold. We also look further at the number of smartphones that are sold and in use globally. So we have an installed base of roughly 5 billion smartphones in use, and they potentially are all customers of ours and sort of within the scope. The good news about the industry, even though smartphone sales have plateaued and even declined in the last couple of years, the accessory market and the audio market is growing. And there are a few reasons for that. One of which is when you buy a smartphone today, there's no accessory in the box. If you recall, a few years ago when you bought an Apple phone, for example, it had a headset, it had a charger, and a cable. When you buy an Apple phone today, there might be a cable, but that's coming out as well. So the market in itself, or the aftermarket, is growing for that reason. We also see average selling prices of accessories going up, meaning that there are more true wireless products sold than wired headsets in the past. True wireless costs probably 3 to 4 times more than a wired headset. That's sort of driving average selling prices. And the third factor is that people are buying more accessories per device, meaning that in the past you maybe bought an extra charger, but now you buy a headset, you buy an extra charger, you buy a case and a screen protector. So average selling attachment rates are going up as well. So the overall industry is growing. This morning, we've been talking about it for a while. We released our Q3 report. We announced that we are discontinuing certain parts of our businesses that sort of the board felt after a detailed assessment weren't really a fit for the mid to longer term objectives of the group. So we took a decision during the quarter to divest 4 businesses. Number one, the health and wellness business, which was launched in 2020 as a response to the pandemic. I think we had been fairly successful, but if you think about sort of where we came from on accessories and audio products, dealing in face masks and gloves really isn't a good fit with accessories. There were some synergies, but at the end of the day, this business unit is probably better suited with a different owner. We also decided to divest our licensing business. We have a legal entity that has global licensing agreements with Adidas, with Diesel, and a couple of other global brands. That business has suffered quite a lot since the beginning of the pandemic. Still, there's a lot of valuable assets in those global licensing agreements, which have a few years remaining on them. Then two more recent digital native brands we had launched back in 2020, both audio brands, really not been able to get the traction we expected. It's becoming more expensive to launch products and capture sales online, and we agreed and decided to divest these as well. We are at different phases. One of these divestitures has been signed, two are being negotiated, and one sort of daughter is a little bit further out, but we expect to complete all of these three within the next 2 to 4 to even 6 months, maybe at the latest. So we expect to be out of them within the next half a year. So what this will do, it will simplify our business. It will simplify our group structure. It will make us leaner and hopefully more focused. And sort of a part of the strategic objective was to really simplify and have fewer businesses that can really make a difference to our future success in terms of scale. And I believe we're left with that. But if you look at these discontinued businesses in the first 9 months of the year, they've lost 4.6 million euros in EBITDA just in the first 9 months of this year. So they've been sort of dragging the rest of the group on a consolidated basis down. So that's why we are divesting them. But we also strongly believe we're not going to take a financial hit as a result of divesting those business units or brands. Second point I want to make, sort of as an impact from the divestitures, we will, as a result, strengthen our balance sheet. So there's a trade credit facility directly tied into the health and wellness business, which was established with our existing lender, Proventus. It's a $20 million facility, which is directly related to trades and larger tenders we were focusing on in the health and wellness business. And that will be repaid as a part of the divestment and will be out of our balance sheet no later than June 30 this year. And that's a $20 million facility. This will also we expect that the health and wellness divestment will also increase and improve our liquidity position. Our inventory will go down as a result as well, so we should come out of this with a stronger balance sheet as well. Not only are we getting rid of loss-making businesses, but also an improved balance sheet should be a part of the outcome we are seeking. Another thing we've talked about earlier as well, when the pandemic hit, there was a lot of shift from traditional retail into online. We wanted to make sure that we were relevant and present in sort of online commerce, and built up a large organization here in Stockholm. We actually hired, I believe, close to 20 people that were just focused on generating sales online. And we lost, unfortunately, a lot of money in the last 30 months or 2.5 years since the beginning of the pandemic, and we really made a conscious effort to go into D2C with our brands. We've lost a combined of 6 million euros just by those initiatives. And it's related to, we were driving negative margins on sales. It was becoming increasingly more expensive to buy customers. Marketing on social was becoming increasingly expensive. So we were generating negative margins, and then we had an organization of 20 people. On top of that, obviously, then it was a recipe for disaster. We've now phased that completely out. We still engage in e-com, but in a completely different way. We don't buy or invest in performance-based marketing. We use sort of more the traditional email campaigns, influencers where we seed products. We don't pay the influencers. So it's a different tactic. And already we're operating our e-com at break-even, albeit at significantly reduced sales volumes. We also engage actively with our retail partners, sort of indirect e-com, when we provide them with tools so they can drive sales of our own products on their own branded website like they just do in a retail setting. So indirect will be a key part of our e-com strategy going forward, as well as online marketplaces where we still have Brandwell as an active participant in Amazon and some of the other marketplaces out there. But if you look at the remaining, what's remaining in Strax after the divestment? So we have a very stable and strong European distribution, a traditional warehouse set up in central Germany that services all of our customers in Europe. We have under that distribution business 8 sales offices across Europe. Then we have 4 own brands, all of which we feel are to some extent unique, with a strong product portfolio and a point of differentiation, which is critical in today's retail environment. Urbanista, a personal audio brand, very strong relationship with Exeger, have launched 2 sort of products that are world's first when it comes to solar power. We have a brand called Clicker, which is an attachable category product. We have a brand called Planet Buddies, which is a kid sort of oriented brand with a very sort of high focus on sustainability in terms of materials, as well as sort of the characters under the Planet Buddies product range are sort of all animals that are facing sort of extinction, which is a nice positioning. And we've teamed up with the WWF to sort of really get that message across and then donate a part of the proceeds of the sales of the product. So we feel that with this sort of more condensed, more focused organization, we're going to achieve a lot of increased benefits, and we can also sort of invest more, given that we've gotten rid of the loss-making businesses that have been dragging us down. Growth agenda has nothing really changed. We are obviously not in the market of launching new brands, which used to be sort of a part of the agenda to grow. We're going to stay within the 3-4 brands we currently own and ensure that we maximize the potential of those brands before we venture into new brands, if ever. So we've learned a lesson, and we're going to just stay within the core and focus on the 3-4 brands that we currently own. A quick sort of case study: we acquired a brand called Gear 4 in 2015 for 5.5 million euros roughly. It was a cage protection brand. We managed to grow that and scale it up from $1 million in sales to $24 million in sales in 3.5 years, and ended up divesting that brand to a large industrial player called SAG, and at a sort of a 7x multiple. And we feel that all of the brands that are remaining in the portfolio still have that chance to take that same trajectory. And a critical market for us to achieve that is North America, where already we have listings of Urbanista in more than 10,000 doors. Clicker is in more than 12,000 doors, and we expect to double those next year already. Planet Buddies has secured strong listings with retailers in North America, no, in Canada, and we expect the US to follow next year. So all of these 3 brands have great potential, and I would say they all have the chance to sort of follow the same revenue trajectory as we've seen with or experienced with Gear 4 because of the strong presence in the US. On the financial highlights, I'm not going to go into any details on this one. Just want to stress that our sales in the first 9 months of the year, roughly 82 million, EBITDA of 5 million euros, and even EBITDA achievement of 5 million. Here we've already absorbed or taken into consideration 1 million euros in loss coming out of the e-com, direct-to-consumer e-com business, which now is operated at break-even. The other point I want to make is that the macro conditions are tough, and we don't expect those to ease sort of in any material way until late 23 or even early 24. But we feel strongly that in this more focused and leaner structure, having gotten rid of the loss-making businesses, we're going to be in a much better shape to still deliver sort of solid numbers and be able to withstand an extended period of hardship in the market. And why Strax? I think the biggest sort of single biggest point here I want to make is that the management team is very experienced. We've been around in the industry probably more than most, and we've seen a few cycles, and we've survived all of them, and we're going to survive this one, of course, as well. So I think the team we have is super solid from A to Z.
Thank you for that, Gudmundur. Now it's time for a Q&A session, and I start with, you talked about the macro environment. What's the worst part of the macro for you right now?
There's so many. No, so obviously the strengthening of the US dollar has eaten into our margins. We're looking at, in the last 15 months, 20% decline of the euro against the dollar. We've tried to offset that with price increases, but there's only so much you can do in terms of pushing price out to consumers. But of course, that's something we've had to do. 2 weeks ago, I thought the supply chain constraints out of China were easing. China announcing less restrictions when it comes to COVID. And now, in the last 3 days, there was a record number of COVID cases in China yesterday, which is possibly impacting the factories we use in China. But again, the good news is that we see freight coming down from their peaks we saw 12 months ago. But of course, now it's also concerning demand. People are holding back on buying a new smartphone. And even another challenge we face is that those that want to buy a smartphone, let's say an iPhone 14, they're just not available. Apple has had constraints, especially on the Pro series. And now their factory, the main factory in China at Foxconn, is closed because of COVID. Apple has already communicated they will sell 6 million less devices in Q4 due to that. So there are so many things we're managing on a daily basis, and it changes so fast that we have to be very reactive. But I would say FX is the one that is hardest to absorb because of the impact on our margins.
Yeah. And when we talk about FX and the US dollar, last time we talked about an increasing sales from US. How's that working?
Yeah, obviously, when we buy in dollars, sell in dollars, we're not exposed to the strengthening of the US dollar. So that, in the mid to long term, will help balance out the negative impact from the dollar and hopefully benefit us once we see real profitability out of the US market. This year, I would say roughly 20% of our sales is coming out of the US. And we expect that to go to probably more than 50% within the next 2 years.
Yeah.
So we have very strong traction with all our brands in retail in the US.
Yeah, because last time it was Clicker that you mentioned in the US. Yeah. The other brands, are they in US or?
Urbanista has listings in a couple of main retailers. There's a dialogue ongoing with a couple of other big ones. Yeah. And what's really helping us and has elevated the Urbanista brand is the collaboration we have with Exeger. So the world's first solar-powered over-ear headsets, the world's first in-ear true wireless headsets, and given where we are in sustainability, I think the timing is great. And this has helped us open doors in many of the larger retailers and telcos in the US in particular, because sustainability obviously is very high on the agenda and in the executive suite. And when it's pushed down, it increases the pressure on the procurement organization to list products or brands that have sustainability high on their agenda. And Urbanista is definitely there, particularly with those two products.
Yeah, and you mentioned the Phoenix.
Yep.
How's the market taking in the new Phoenix? Do we want to buy them, or how's the?
We always want to sell more. Yeah. But at the end of it, it's a great product. Not only is it unique because it has the solar panel on the actual charging box, but the quality of the sound quality, the build, it's an excellent product. It is at a price point that is not necessarily competing with the AirPod Pros, but it is a relatively high price point. And in the volumes there, they are certainly lower than what you can expect sub 100 euros, sub 80 euros. But so far, we're happy with the listings, and hopefully they will sell through in retail at that price point. But it's a unique product that always helps when you're positioning, when you're marketing a product to have something that nobody else has.
Yeah. And you talked about the margins. In Q3, we saw the gross margin raise quite extensive. What's the reason for the raise?
I think it's a combination of factors, one of which is product mix.
Yeah.
Another one is brand mix. Those are sort of the largest factors impacting the margin. We also have had service income from logistics services, which generate higher margins than product margins. So I think all of these factors have helped improve our margin. But our longer term, so we used to operate pre-COVID at, I would say, significantly higher margins. And obviously now divesting health and wellness, which has been dragging down our average blended gross, divesting sort of the loss-making e-com brands which generated negative margins, all of this will help us sort of get closer to the pre-COVID levels, and hopefully the euro will start strengthening or the US giving in. So we'll see sort of healthier levels on that FX cross.
Yeah. So you expect to raise the gross margin when you divest the other brands?
Yes, that will happen because health and wellness margin is significantly lower than when we sell an accessory product. That's just a fact.
Yeah. And your distribution business are still very strong.
Yeah.
What's the driver behind this growth?
I think it's twofold. A, we have a very strong customer base, long-standing relationships. Obviously, traditional retailers have suffered since the beginning of the COVID. We have also a very solid enterprise customer base. So when we target or Deutsche Telekom, which is T-Mobile in Germany, we've been their accessory supplier of the year for the last 2 years. And we go with them when they are tendering for business at, let's say, Mercedes. They're trying to sell in 50,000, 20,000, 10,000 smartphones. They bring us in as the accessory supplier for cases, screen protection, chargers, etc. So that's been a growth area basically since the start of the COVID. Enterprise business has been very solid.
Yeah. And the last question, if we look into the future and 2023, where do you see Strax is in, say, 1 year?
It's a difficult question, given sort of the uncertainty we see sort of in the microclimate. Yeah. If things are, and we expect similar climate for the next 12 months. We don't foresee a major change until sort of Q4 next year or even Q1 24. That's why it's so important that we've sort of taken the steps of divesting these loss-making businesses just to be able to withstand a recession. Yeah. We're not necessarily calling a recession next year, hopefully not, but we won't see sort of a massive GDP growth in any of our markets. Hopefully we will have sort of sales still anywhere 120, 130 million, ideally higher margin and still sort of solid profitability.
Yeah, thank you for the answers and thank you for the views. If you have any questions on Strax, you're warmly welcome to reach out to me by hugo.licho@penser.se. Thank you for watching.